All righty, let's get started. Good afternoon, everybody. On behalf of the PKE Alumni Executive Planning Committee, I'm Bill Barkovitz, PKE 139. And I'd like to welcome you to the PKE Faculty Speaker Series, today with Dr. Clemens, Kownatzki. And his topic is Innovation in Finance, the Future is Now. Just a note, we are recording this today. I'd like to also thank my fellow PKE Executive Planning Committee members, Alan, Amy, Andre, and Jeanette, for helping to put this together. We are looking for more cohort champions to support the alumni events and lead connections in your cohort. So if you're interested in becoming a cohort champion for your cohort, please reach out to one of the planning committee members or to Nicole at the alumni office. Also, don't forget, if you haven't joined, please join Pep Connect. This is where we have PKE group events and information is listed there. So please sign up if you haven't done so already. We always like to remind all the alumni that there's no better way to improve the school and improve our alumni group than recommending people you know and people you think would benefit the program. So please recommend people to PKE and other degree programs. Pearl Quintana is the contact. Her information is listed right here. We'd also like to acknowledge our executive associates who support the Graziadio Business School and its philanthropic efforts. So at this time, I'm going to introduce Dr. Dimos Vardiabasis, Professor of Economics and PKE Faculty Committee Chair, who will provide an update and introduce Dr. Clemens. Dr. Dimos has over 25 years of experience as a professor, entrepreneur, executive, and consultant. He's founded several companies and has served as chairman and CEO of the IQ Now Corporation and of Health Windows, which provided services to companies such as American Express, Hilton, Yamaha, and Honeywell. As a consultant, Dr. Dimos has worked with companies representing a wide range of industries. He's been an advisor and board member for several startups. Dr. Dimos has extensively published in journals, magazines, conference proceedings, and most importantly, he was my economics professor when I was at PKE. So with that, I'll leave it to Dr. Dimos, please.
Thank you, Bill. Always is nice to hear the introductions from you. And of course, it's a real pleasure to see all of you here. Some of you that I have a few years to see, going back, 20, 30 years ago. But I'm excited that we have another meeting today. And that's a great thing that the alumni is putting together. I hope that we can help you and make this series even more successful. Thank you, Nicole, Deborah, for all your efforts. And of course, the organizing committee, along with Bill, Amy, Jeanette. It's very, very encouraging and helpful to have you all participating and trying to make our program even better and make the life of Perla, who is bringing newer students in our programs today, much easier. So thank all of you. Of course, today I'm great honor and extremely happy that we have one of our best professors at the School of Business and Management, Dr. Clemens, who is going to give us a talk about the areas of financing, innovation, technology. Every time I look into the linkage, I see a new article written by him. He has a tremendous amount of energy. I don't know where he finds all this energy, but it's a pleasure and honor to have him in our school. And also at the PKE, has become now a permanent member of teaching the course of finance. And that's a really pleasure for our program and of course for our school. He has done tremendously well in his private life as in addition to being a professor at Pepperdine. He was a student at Pepperdine and a PKE. That's where he got the love for PKE. He did his PhD, and also he's been very successful in the private sector before joining Pepperdine on a full-time basis. He's the associate dean right now with the full-time programs, and he's doing an outstanding job there. One of our best administrators I have seen in my life, Pepperdine, which is right now, this year is the 48th year for me being at Pepperdine. So whatever I say about him is, please consider it very, very important. With that, I will have Clemens, professor, to take over his presentation, and I will start driving because I'm going from here to his office in Malibu. Now, how I can do it? I will be on the phone, but not on Zoom right now.
Thank you, Demos. I don't know if I can recognize myself with all these kind words that come from you. It's an honor and a pleasure to be working with you. It's like you said, I joined PKE 25-ish years ago or so, and I graduated in 2000, so almost 23 years ago. So it's come full circle, and it's a huge honor and a great pleasure to be working with you, as well as a few other illustrious professors, including Kurt Motamedi, who was my professor in strategy some 20 years ago. So it's a wonderful pleasure. Thank you all for joining me. Let me see if I can share my screen and not mess this up. You can see this okay. All right, so we'll talk about what happens in innovation in finance. And to get us started, let me give you just a little bit of an agenda for today. So before we look at what happens today and what will happen in the future, it's always good to look back first, right? So we can't really understand the present or the future if we don't understand history. So we'll do that first. Then we'll look at what financial markets are doing, what products are today, what potentially could happen to tomorrow. And I will also give you a bit of a show and tell. Some of the systems that have come across my desk, I'll show you at least one tool that you can use right now, tomorrow, in your own life that might help you with your financial planning a little bit. And then towards the end, we'll do a Q&A. So that said, looking back a few thousand years, interest, the financial interest has been around for a while. So the first documented references of what interest is and how it should be calculated go back to the so-called Code of Hammurabi. That was 1750 before Christ. They actually said there's a maximum level of interest that you can charge for anyone lending you grain or lending you some money in terms of silver. And at the time, 33% was the maximum for grain, and about 20% was the maximum for gold or silver, or any type of monetary lending. And so if you go back in history, so we've had all these episodes. So some 2,000 years ago, before Christ, we had the form of loans in the Middle East, in the Far East. It took a long, long time before we actually have a true banking system, as we call it today, with the Medicis in the 14th century in Italy. And then the emergence of modern banking really happened in London with the goldsmiths in the 17th to 19th century. It's just very recent since we had official central banks as lenders of last resorts. And then putting in a bit more technology, the first ATMs were actually in the 60s at Barclays Bank in London. And then going back a little bit further, 1994 is when we saw first online banking. And then things like PayPal, Y2K, the early 2000s, very rapid development of online financial services. So we have, on the one hand, the old school savings, checking accounts, mortgages, stocks and bonds. And then we have also engineered products, derivatives, ABSs, CMOs, all these acronyms that you hear, structured products, and more recently, financial infrastructure or financial systems until today. So when I talk about financial products, I would also recommend that we look at a production line of how these financial products are produced, so to speak. So we'll start with some assets, and then we have some sort of a mechanism where we have a combination of algorithms, theory, and regulators that kind of go through this funnel of financial engineering and spit out various financial products. So you might have heard terms like futures, options, things like asset-backed securities, collateralized mortgage obligations. Then we have all these hybrid securities. A lot of times they are ETFs, exchange-traded funds, and structured products. So this is what I would call financial products. And then at the end, we have an end user, an investor, a retail investor, a lot of times, that uses these financial products. So when we look about financial innovation, I call these the 5 C's of modern finance. So all of these areas give us a rationale as to why innovation is so important. Competition, first and foremost, right? If you think about what makes companies come up with these financially innovative products, competition clearly is one of them. Cost savings a lot of time is a factor, but very often also consumer needs and demands. And then every time you have a crisis, there's going to be a backlash and there's going to be a regulatory change as a result of these crises, and that spurs innovation again. Last but not least, something that I can really associate with is chasing the Holy Grail. What is the Holy Grail? Everyone who does financial research is trying to figure out what is the model, what is the secret ingredient, that special sauce that's somewhere out there that allows us to kind of figure out how to make money in finance, right? And a lot of us who do research actually spend a lot of our daytime and nighttime hours trying to chase that Holy Grail, trying to figure out what can we do or what model can we use to have a higher probability of success when we invest our money. Examples of these innovative products are, for example, the Black-Scholes model, option prices, option pricing, exotic options. Now, you may have heard derivatives, and derivatives have been a little bit more popularized after the last financial crisis in 2008. And famously, Warren Buffett said that derivatives were weapons of mass destruction, or financial weapons of mass destruction, which I think is a little bit ironic because he himself used them extensively, especially right after the financial crisis. But if you want to find a rationale as to why we have derivatives, going back to our 5 C's that I mentioned earlier, derivatives are primarily used to manage risk, not to speculate or to gamble. The primary use of derivatives is to manage risk. And I want to go back a little bit in time, the end of the Second World War, when the major Allied nations basically decided the financial world going forward. And at the time, at the Bretton Woods Agreement, it was decided that the US dollar was supposed to be the reserve currency, backed by gold at $35 an ounce. We also saw the creation of the IMF and the World Bank. And then we had that for a couple of decades, we had a system that worked really well, where the US dollar and many other currencies by default were backed in some form by gold. That system didn't work all that well eventually because famous economist, Mr. Triffin, came up with the Triffin dilemma that suggested that this system of floating exchange rates, of fixed exchange rates was about to break apart. And And it was simply the fact that it is not possible for the US dollar to be a safe haven currency, the anchor of the world currencies, and equally having the ability that every other nation, particularly Japan and Germany at the time, would accumulate dollar reserves and thereby weakening the dollar. So the system itself led to a continuous and still ongoing trade deficit for the US. Under Nixon, he suspended the gold to dollar convertibility, initially floated the gold upwards for $38 an ounce, but eventually it really came to floating exchange rates. At the same time, we had the creation of financial derivatives. There was a famous paper in 1972 by Fisher Black and Myron Scholes, and then also Robert Merton, that came up with this model to price options, financial options. And we also had the creation of currency futures and currency options at the Chicago Mercantile Exchange. And when you think about it, why was this confluence of all these factors so important? It is because all of a sudden we had these countries that all of a sudden were exposed to currency risk that was not there before. We had several decades of fixed exchange rates, and then all of a sudden we had floating exchange rates, and that created a risk for them. And so we had this wonderful confluence of having the theoretical knowledge, the financial products for companies and large institutions to manage risk via derivatives. So again, the demand creates products. It wasn't something that was really forced upon the investing community. Oil futures. We could say a similar argument for the housing boom in the early 2000s, that at the top of the housing crisis or the housing boom, the Case-Shiller housing price futures were created. And then similarly, Bitcoin and blockchain, when that really got hot, was the creation of Bitcoin futures. But again, primarily from the perspective that there's an associated risk from an area that was not there before, and then the financial institutions created products that give us the ability to manage risk. And so I call that a little bit the financial supermarket, where we see a proliferation of products. So looking at some of these numbers, we have over 7,600 mutual funds in the US today. We have almost 4,000 hedge funds. As of 2021, we had 2,600 ETFs. Now, as of this month, we have 22,000 crypto assets trading on over 500 crypto exchanges. Long story short, I'm not going to go into cryptocurrency or blockchain, but it is something of a topic that will be addressed, hopefully this year, by the regulators. We also see all these structured products. These are a combination of different types of derivative products. We also see a proliferation of robo-advisors. At the same time, we actually see that this notion of mutual funds and mutual fund managers trying to beat the market, that they're actually doing a really, really poor job. So according to the S&P, over 80% of large cap funds underperformed the S&P 500, which begs the question that why should I give money to an investment advisor or a mutual fund manager when they can't outperform the market? And that is one of the rationales why we've seen really a stark movement and a trend going to ETFs versus mutual funds. And then generally speaking, we see that there's going to be more data. No matter what you do, we are inundated with data. And because of that, the traditional financial tool like Excel has limitations. There's only 1 million rows, only in quotation marks. But nowadays, 1 million is not a lot of data. So we need expansion of new tools. We have databases, the traditional ones, SQL, Oracle, SAP, and so forth. but now we see a lot more development in analytics, SAS, R, Python, Java, and so forth. And that leads to the development of additional financial products. Meanwhile, the regulators are trying to catch up, but we even see more and more data in financial regulation. If you go back to the early 1930s, the Glass-Steagall Act was a mere 37 pages. The Dodd-Frank Bill of 2010 was 849 pages, and by the time it was done, it resulted in 30,000 pages of rulemaking, which again begs the question, can anyone understand it? It's a bit like the tax code with thousands and thousands of pages of rules that very few people actually understand. And then going back to a little bit more of the trends that I'm seeing. So over the last 30 or so years, we've not seen a lot of change in the mutual fund industry. They've been actually almost sideways. However, ETFs, the so-called exchange-traded funds, have seen a huge growth. So at the moment, over 2,600 ETFs exist in the US. There's a little bit of a grain of salt here because not all of these ETFs are the passive index tracking funds. A lot of them are actually hybrid products. And yeah, begs the question whether they really should be called ETFs, because many of them are a little bit sophisticated, too sophisticated for the traditional investor to really trade. Also seen a trend of AI taking over, and we've seen a trend of so-called robo-advisors that come to the fore. This is a little bit older and haven't been able to get more recent data, but in 2017, there were over 200 robo-advisors in the US. So questions now, is it bots over brains or is it brains over bots? So we do have a trend that suggests for some people, a robo-advisor might actually make sense. And anyone who's talked to their financial advisors, they probably have heard them say that, well, we have these products and, you know, the fees are such and such. We also have that robo-advisor and they have a good track record and so forth. But, you know, for somebody who has managed portfolios for a long time, my first question is, are they safe? Are they as safe as self-driving cars? Is the technology good? Is it there yet? Or is it something more like a tail is wagging the dog, that we have something that is actually developing, but it's probably not quite ripe for prime time? And what we've seen in the last decade before the pandemic is that almost anybody was a great financial expert. Almost anybody did well in the market. It was almost like, you know, throwing darts at the board and, you know, picking up a few stocks, and they all did well because everything went up, you know. And that's kind of that self-fulfilling prophecy. If everybody's using the same robo-advisors and everybody thinks the same, you have that kind of complacency that comes about. And that has an impact on all of these products that eventually come about. So question to me is always like, when I'm dealing with robo-advisors, what's in that so-called black box? What is the algorithm? How does it actually work? And I'm, you know, as a financial expert, I want to know what's inside that black box. And I think for a retail investor, at least conceptually, they should understand what's inside the black box before they put their money at risk. So when I talk about the future is now, there's a ton of websites, and these are just some examples of what's going on in finance. You have probably used some of these before, Google Finance or Yahoo Finance. You've used probably FinViz or Stock Charts or a few other ones of those. And that speaks to the technology aspect of some of these financial companies that are at the forefront of financial innovation. Now, having said that, there's some that I haven't mentioned. So I haven't mentioned JP Morgan or Bank of America or Wells Fargo or Schwab or, you know, some of them, because I think they've been pretty stagnant. at least on the retail side. When it comes to investment banking and how they make their money in sort of the, the risk area, they've been very, very, very aggressive. But on the retail front, we don't see that yet as a customer. So I want to give you some examples of what some of these tools are and how they exist. And you can use them, at least the first ones that I show you right now. If I can see everybody here. Is it possible to see kind of a show of hands? How many of you have used Google Finance before, or Google Sheets with the finance application? But you can create a Google Sheet and then enter some formulas, and then you can create stock prices, charts, and whatnot. I'll actually walk you through a couple of examples like that. So Google Sheets has an integrated finance function that allows you to download various stock prices, but also other variables that are associated with public markets, with stocks. And this, just saying, this was over a decade ago. More than a decade ago, you could do stuff with Visual Basic applications in Excel. You can run macros, and you can do very fancy stuff just in Excel. And this has been going on for almost 20 years now. This dates me, back in the early 90s, we had, in our systems, we had Reuters and Bloomberg giving us data, and the data were put into Excel in real time, where we can use our analytics to do our analytics calculations and pricing for being a market maker in Excel in real time. And that was, 30 years ago. So this is not really new, but for a lot of people, it seems like the future. So a question might now be, where are we heading next? And this is always interesting for me, both as an investor and also as an observer of technology. The so-called Mara's law that basically suggests that we overestimate technology in the short run and underestimate its influence in the long run. And you can use a lot of examples. Back in the 90s, I think some of us are old enough to remember what the 90s were. In the 90s, it was possible to have any name, as long as you had .com in your name, people would give you money, right? So clear overestimation. So it's a total kind of bubble formation of people flooding money into a particular thing. We also had this notion of the information superhighway that was talked about in politics a lot, and then never happened really until probably the early to mid 2000s. Some of you might remember 3D printing. We had some companies that had 3D printing associated with them. Stock price went up and busted in a few years. And then also Bitcoin and cryptocurrencies, where we see massive bubble effects, and as we speak, ongoing. And like I said earlier, I could do an entire episode on just Bitcoin and cryptocurrencies. I'm very much on the fence as to whether this is a useful development. Cryptocurrencies themselves, I can see a fascination for me just in the technology and in the math behind it. But I know that the world doesn't need 22,000 crypto assets. The world does not need thousands of cryptocurrencies. The world does not need speculative assets that lure people into this sort of gambling attitude. And then at the end of the day, does it really make sense to have these thousands of cryptocurrencies as a vehicle, either as a store of value, which is a definition of currency, or as a medium of exchange, which is another definition of a currency, right? So at the moment, I don't see that happening yet. Store of value for me means that I can put my money in something and it stays more or less the same. And you've probably heard the term stable coins. A stable coin, by definition, means it should be stable. It should not go down to 50% of its value or down to zero. It's not, that doesn't mean stable to me. And I don't see the point in stablecoin when I can just have my money in dollars or in euros or some other stable currency. So I'm really very much on the fence as to whether cryptocurrencies, that whole space, it makes a lot of sense. And I try very much tell my students, especially the younger ones, if you want to gamble, fine. It's a lot of fun to do that. I think you get better value by driving to Las Vegas and blowing a few $100s, because you get a nice drink and a nice meal along with that, and maybe have some friends along the way too. If you want to gamble in cryptocurrencies, that's fine too. Just don't put more than 1 or 2% of your assets in it. And sadly, I've seen it with some students and a lot of the younger folks that I've talked to, that they had all they ever saved was $10,000, and they put it all in a couple of cryptocurrencies, and it, sometimes it's nice, but a lot of times it just poofs up into air, and it leads to devastation in terms of their financial well-being. So I'm not a huge favor of speculative assets, and I'm saying that as a speculator. I ran a market maker before, so I know what risk is, and I like taking risk, but I like to do it with a little bit of control. So I very much like this notion of defined risk. Defined risk means whenever I put risk in there, I know how much money I can lose on each trade. And that's not the case for what I've seen, either in cryptocurrencies, in some of the meme stocks that came about during the last pandemic, and some of the SPACs that have come about. Now, I know I've thrown a lot of acronyms at you. ICOs are, and SPACs are kind of these things. But what's important for us to remember, and I say this to the younger student all the time, is if it sounds too good to be true, it probably is. So these people who tell you that they make 20% every month, that's just baloney. That's just not real, and it's certainly not sustainable. So keeping that in mind is really important. But going back to innovation, because we have a proliferation of more and more data, not just in finance, but in anything we do, whether you're doing marketing or you're doing strategy or whatever kind of discipline or division in your firm you are inundated with more and more data. And so that means we have to have new tools and new awareness and perhaps some new skills to allow us to deal with the data. And so I'm just going to run you through some examples of tools that are out there currently. This is a company that I've worked with. It's called Row64. They basically built Excel on steroids. So you can use your spreadsheet. You can load not just 1 million rows of data, but you can do 100 million data points, and it loads it within a second. But what's really neat, it allows you to use the Excel type language where you have something like this code here, get symbols, and it translates in real time into Python. Python is a coding language that people can use to do very sophisticated tools. So that's out there and it's working, and I'll show you an example for it in a minute. And then you've probably heard AI. Almost every company nowadays that says they are a technology-based company have some sort of an AI. And until a few months ago, I thought most of that AI stuff is just baloney. And I thought it's really just some glorious if-then statements, a little bit of machine learning, a little bit of, stuff that you can do in simplest formats, very, very sophisticated Excel type code that's nested if-then statements. But then I saw this thing called ChatGPT, and I thought, wow, let me try this. And before I knew it, I spent 6 hours without drinking, sleeping, eating anything until midnight to play around with this tool. And for the first time, I actually thought I saw the future. I thought I saw what is possible. And just simple examples here I want to give you, and I'll show you some if ChatGPT is still working. I basically said here, ChatGPT, write me some Python code to download some stock prices. So this was the instruction I gave. And then ChatGPT came back and wrote the code in Python. And not only that, it also showed me a little bit of what it does. It explained actually what it did. And so I was fascinated because that sounds just like me having a conversation with a PhD student, having a conversation with a research assistant where I say, hey, I need this data. I don't have time to write the code right now. Just write me this stuff or write me a model for this and this and that so I can do some research. And you give these instructions to an RA, a research assistant, and then a few days later, they come back with an answer. And then you say, oh, wait a second, you made a mistake here. Why don't you try this? And then you send that an email or you have a meeting, and eventually you get the right answer. But it might take you a week. It might take you several days. Here, you have the answer in a few seconds. And so in terms of productivity gain, it's fascinating. It's kind of mind-boggling. But of course, there are certain caveats. This tool is nowhere near prime time, but you can see where it can go. But it also requires you as a researcher or as a financial analyst or as an investor to be very, very critical of what this code does. That's equally important. So it requires that you have a basic understanding of coding to find the flaws. The other fascinating thing I found is that I tried various codes with ChatGPT in Python, and it gave me an error. So what I did is I copied the error code back to ChatGPT, and it corrected itself. And if you do that a few times with really just 3 or 4 iterations, you get to the actual answer that you wanted. And so, at least for finance, I can see a huge use case for these AI tools. And this is actually closer to what I would consider AI than, you know, the traditional stuff that's been touted and been greenwashed by a lot of companies that suggest that they have AI. Now, as an investor, I would caution you that not every company that has AI in their name is actually having AI and is actually using AI and is doing a good job in AI. But I can already see that investment dollars are going in that direction very, very quickly. And sadly, there will be a few losers out there as well, in addition to the winners. Here's another example where I said, hey, send me some code so I can download stock prices and then create a chart along the way. And here's yet another example where I said, you know, I need a correlation matrix of 10 stocks. And I just gave very, very basic instructions. I just said, show me an example of Python code to create a correlation matrix of 10 stocks. And so this machine then not only did that, but it also did something really cool, which is it took the 10 top weights in the S&P 500 as the tickers that I should look at for correlations. And again, I was kind of blown away because I didn't give that instruction at all. It just assumed that this would be a good way to go. And here's kind of the correlation I find with when you guys do Google searches, for example, you type in something and then Google gives you, I don't know, 1,000 references. And it doesn't necessarily give you the best one. The best one might be in page 4 or 5 of your search queries. And the problem with that is most people don't have the time or the patience to go to the 4th or 5th page. We typically just stay at the first page, and these are not necessarily the right answers or the best answers. But I can see how these AI chatbots get you closer to the best possible answer rather than giving you 1,000 answers that you still have to find the time and the resource to figure out which one is the right answer here or the one that works best for you. So I find that fascinating. But I want to go back to the slide deck and now show you a couple of things that might wow you a little bit. Well, let me try this first. You might recognize this as just a normal spreadsheet with Google Sheets. And so the code here is very, very simple. It's really just equals Google Finance, and then you define your ticker price or your ticker, Microsoft in this example, a price, the starting date, the ending date, and you want daily data. So all you need to do is type this code and you have the stock price. Now I'm going to modify this and make this into Apple. And here's your Apple stock price. So took a second and you have it there. You have the data for Apple stock prices. You can take this now and you can modify it a little bit, and you can do references just like you would do in any spreadsheet. Instead of typing everything into the code here, you can reference the code into something associated here with another cell. And so it makes it easier for me to modify the code. So I can go back to taking a Google price. And then once you have the data, you can modify it even more. And you can associate it stock returns, the ticker price, you can develop some summary statistics. And this is literally, it takes a few minutes to put this together. So again, if I want a different stock price, here's my chart, here are my summary statistics, and off you go. And this is a tool that's free. It's been around for more than a decade. So when I talk about innovation in finance, it's already there. We've been using this for a long, long time. And it's available for free at the retail level. The other thing I wanted to show you, and I'm hoping I can still make this run because ChatGPT had issues. Can you still see this okay? Yeah. So ChatGPT had issues with overcapacity. So I can try and do something now. I can say, write some. Should know how to type. So here's the answer. So it types the code. And it gives you an explanation of what it did. So I can just click on this button here and say copy code. Then I can go to my Python interface here, and I just paste it into the code. Here's an example of what I did earlier with the correlation matrix. So you can see this is really, really quick, and you don't have to be a genius programmer anymore to get very sophisticated information basically for free. Python is a free software. You can download it for free. It doesn't cost anything. Google Sheets, obviously, is free. And ChatGPT at the moment is still free as well. I understand that Microsoft has invested $10 billion into this system, and they're planning to kind of integrate this into either Bing searches or Microsoft Office products. So that is happening, and it's as we speak, literally. I want to share a couple more last minute things, and then I'm ready for any questions that you might have. One second, please. Sorry, I have too many windows open. No. Apologies, 1 second, please. You still see this okay? All right, so a couple of last minute thoughts. Innovation has always been there. It's always been vital for finance because innovation allows financial firms and any firm to be more efficient, to make more money at the end of the day. So the idea that, for example, with Bitcoin, you could transfer money faster and all that stuff, that's kind of funny because in the 90s, we used, with HSBC, for example, we used a hexagon system to transfer money within minutes across the planet. And, it's nothing new. So while we have massive innovation, we still have people, if you go back to your grocery store, you'll see the little old lady or the little old man pulling out their checkbook and then reconciling their checkbook, right there at the cashier. And that's still happening as we speak. While on the other hand, we have people sending money through your iPhone or through Venmo or Zelle. So we see kind of a proliferation of these financial products, but at the same time, the old products are still not going away. They're still there. So staying ahead of the game is actually crucial for a lot of companies. We do see that the new financial products come out almost every day. So I'm very involved in the structured products markets, and they come out with new products every week. In fact, every day. And keeping up with all of this is really, really difficult, even for the experts. One of the biggest issues I have with technology is I don't understand a lot of times what's inside the black box. It's a bit like, most of us driving a modern car today, we can't repair it anymore. In the old days, you can open up the hood and you can figure out kind of what is what and figure out how to fix it if something is broken. Today, that's no longer possible without software. And I think the same is true for a lot of the other products that we're exposed to, including financial products. And we need to ask the question, what does this algorithm or this AI do inside of that black box? At the same time, we know that our cognition is limited. We need the machines. We can't operate today without the machines. But we have to ask some questions, are these machines good? Are these algorithms good? Are they doing something good? Or is this just, like the driverless cars? Is this something that we should just step into and adopt without questioning or without really formally testing it to make sure that they can't do any damage? I saw a really interesting interview with one of my heroes, Robert Merton, the guy who's co-created the Black-Scholes-Merton model. And he said that he sat in a plane, and after the landing, the pilot announced, oh, by the way, I didn't land the plane, the computer did the plane landing. And so he came up with the question, would you sit in a plane where there's actually no pilot? No pilot there, it's just a machine that's flying the plane and does it. Would we feel comfortable with that? It's the same question as, would you feel comfortable to hand over all your money to a machine and just let it manage? I don't know. I think every model that you do, every algorithm or every sort of very sophisticated software is always an abstraction of reality. It's never a complete reality. It's just, an abstraction. So they need to minimize the variables that come in and figure out what to react. What the human brain is really very good at is pattern recognition and understanding how to react when stuff doesn't make any more sense. And if you think of a pilot, they spend most of their training to figure out what to do when stuff goes wrong, right? And so I would suggest that we actually need these sort of financial pilots to run our financial system. People who understand the algorithm, people who understand what's inside that black box. And then when the proverbial hits the fan, they can then intervene and react and use wisdom experience training to land the plane safely so that we're not dead. So in perspective, I would suggest that innovation is there. We're not gonna put the tube back, the paste back into the tube, or the cat's out of the bag, so to speak. But we have to be realistic too. So we have decoded the human genome, but we still cannot cure the common cold. We have people that went to the moon 30, 40 years ago, and we still can't fix potholes in LA. You know, every time I drive through the freeway, I'm afraid that my tire is going to pop because it's horrible. This is third world country here. We have all this technological innovation on top of a very fragile financial infrastructure. And we see what happens when things fall apart. Every now and then we have a crisis and things are not as good as they seem. So I don't know if these algorithms are the solution. My question is, can we develop an AI or an algorithm that's good, that's best for the world, that doesn't do any harm? And my take is really, I prefer brains watching over the bots rather than being exposed to just a machine or an algorithm that makes the decision on my behalf. I want to have the so-called financial pilot overseeing my investments, where I see there's some technical expertise, but also some human element of wisdom and some sort of ethical portion that's important to make the right decision at the end. And so I want to leave you guys with that thought. Should we expose ourselves to a machine that runs everything for us, or should we just, use a little bit of skepticism and perhaps a lot of financial training, or whatever your discipline is, a lot of training and expertise to be able to make the right decision that's good for everybody, so that we don't have somebody, hitting a button without knowing what the consequences are. That's what I had prepared for today, and I'm open to answer any of your questions now.
Thank you, Dr. Clemens. That was fantastic. I did ask the group if they wanted to put any questions into the chat, and we haven't got any into the chat. So if anybody wants to just ask questions here real time, go ahead and fire away. Just make sure you're unmuted.
I didn't want to be the first one, so I was holding out, but hello to all, and it's great to be here. Thank you, Dr. Kownatzki. I wrote down several things that I would like to either comment on or ask a question, but I'm just going to ask one question and one comment. You mentioned about cryptocurrencies and the other types of things that come along with that. And I was waiting to hear central bank digital currencies. You mentioned stable coins as well. So I was wondering, and I just recently learned this theory the other day, Joseph Schumpeter's theory of creative destruction. Mm-hmm. And essentially something new comes along and replaces the old, the horse and buggy was replaced by the car. Right. And so I've been hearing about banknotes being replaced by central bank digital currencies. Just as credit cards and debit cards have in sense, the plastic has in sense, people don't keep a lot of banknotes in their wallets. So as we move towards that, we hear terms like narrow banking through the central banks. So I'm just wondering if that is a more plausible outcome where central bank digital currencies, which are backed by the central banks, they're digital and they're on the they're on the blockchain, is it plausible that they would creatively destroy banknotes and take time, of course, but what are your thoughts on that?
I have lots of thoughts on this, and thank you for mentioning central bank digital currencies. When you think about it, we already have that. And most of us transact with digital forms of payments anyway. And if we believe that whatever the zeros are in our bank accounts, they're also digits. I mean, the banks do not actually hold the cash that is on your account ledger. Our our system of banking is so that the banks are making money from creating additional credits. So credit is actually much more important than what we consider money today. And I don't think it's a huge step to go from banknotes to digital currency. When you think about it, coins make absolutely no sense anymore. It costs so much more money to create these coins than they're worth. It's actually silly to have coins. Banknotes, and your question about the safety of this, I mean, it's easier to probably forge banknotes than it would be to kind of invade or hack into hopefully a relatively secure digital currency that's controlled by a central bank. I mean, China is doing this, and last time I was in China was just before the pandemic, 2019, and my wife and I were approaching one of these street vendors and said, "Oh, this looks nice. Can we just have that?" And the guy just basically pointed, "I don't want your banknotes. I have an iPhone, and give me the money with WeChat credit or some other form of payment." And even some peddler who was begging for money said, we wanted to give them a little bit of cash, and they said, "No, I don't want cash. Give me this in your iPhone." And that was interesting to me, right? That even the guys who are begging for money don't want coins and banknotes anymore. They want digital. And there's something beautiful about cash that we still have to solve somehow. And even though I don't personally think I have any secrets, but there's an element of, I don't want other people to know what I do with my money. I mean, that sort of privacy issue is probably a much bigger concern than the technology part. Technology, I think we can solve today. It's really the privacy. What does the government know about us when they know every single transaction we do?
So that leads me to another question, if it's okay, Bill. So then it leads to the, is it plausible then that cryptocurrencies could stay on the scene, just like when the dot-com bubble burst and all of those dot-coms went poof, but then we saw that what came out of the dot-coms was e-commerce, right? Amazon, et cetera. Could it be then that as we transition from Web 2 to Web 3, that cryptocurrencies really become Web 3 apps?
Absolutely.
that gain value like stock companies gain? And let me try to land the plane on the question. Is it plausible that then they basically just become, and I'm gonna talk about blockchain here by saying cross-chain connectors, where you can keep a little bit of privacy because you can have all of these, but when you go to settle for settlement, you have to use something like a central bank digital currency that is actually backed by something. And maybe is it plausible that could be a solution? Absolutely.
And I firmly believe that 20 years from now, there will be some form of cryptocurrencies, but we're not going to have 20,000. We're not going to have 10,000 or 5,000. We might have a handful. And I can see that use case clearly. But, right now it's a lot of speculative stuff. And just like in other areas before, Google is the monopoly in search still, but it didn't start. We had things like Ask Jeeves or some other search thing that is nowhere now. So I can see the same thing with cryptocurrencies. It may be Bitcoin, but chances are it might be something else that is not even on the radar yet.
Awesome.
But I think within 10 to 20 years, there will be some form of blockchain type cryptocurrency that could be used in a day-to-day transaction, has some level of store of value, and doesn't necessarily use tons and tons of electricity or other energy to be able to just, maintain itself. I think that's another thing that I can't wrap my head around. Why do we need all this energy to produce a currency? It doesn't make sense. It's just economically and ecologically devastating for us to do that. But by the way, I'm happy to answer more questions. Absolutely. I don't know what the time frame is, Nicole, I'm happy to stay on for as long as it takes. But if you do have questions, I'm happy to answer them. Send me an email. We can jump on a call or do a Zoom call. I'm happy to answer the questions.
Okay. Yeah, we've got one question that came through the chat. It says, I'm currently studying for the Series 79 investment banking credentials. Which financial ratios and analysis models do you recommend for evaluating private and public companies?
Oh, Rami, that's a tricky question. There's so many ratios that it's hard to pinpoint. The students always ask me, is there a formula that I can use to make money? No, no, there isn't. Is there a single ratio that will tell you a company is good or not? No, there isn't. I think it's a combination of things. Rami, I'm happy to jump on a call with you. I can elaborate that. It's difficult to answer that in just a few sentences.
I'll reach out to you, sir. And it's,
Yeah, please.
This was such a fantastic talk and so timely and so beautifully put together and so digestible. Although I fear that I'll probably need to hear this a couple more times to fully absorb everything you said, but it was really very useful and wonderful. Thank you so much.
Yeah, my pleasure. And if you need the links to some of the tools I showed you, I'm happy to do that as well. If you need any additional information, just email me. I'm happy to share all of that.
Great.
Thank you so much.
All right, I think with that we're going to go ahead. If there's any other quick questions, we can take them. Otherwise, I think we'll close for the day. Someone is asking about a replay, and I believe we do have the recording available, so that will be available. If you attended or signed up for it, you'll have availability to that. So good. Thank you very much, Dr. Clemens. That was fantastic, and everybody else. I think you will be receiving a survey by email from Nicole, so please look out for that. And with that, thank you, everybody, and have a great afternoon.
My pleasure. Thank you all.
Thanks.